The head of Australia's second biggest property group, Stockland, has warned banks against lifting mortgage rates independently of any official moves by the RBA. Matthew Quinn says it would pose a huge threat to the recovery of his company and the wider economy. Here's Francis Bell.
Stockland is back in the black, and Managing Director Matthew Quinn is confident the company is well past its woes of 2009.
The global economy is still quite fragile, obviously, and we don't know what kind of volatility is ahead. But we've now put ourselves in a position where we can withstand just about any storm.
Stockland posted a $1.8 billion loss last year amid the fallout from the global financial crisis and tumbling property prices. It's recovered to post a net profit of $478 million for 2010. Underlying profit is up 10% to $692 million. Property fund manager Winston Samet says the results reflect a more disciplined approach by Stockland.
They've been quite guarded in terms of what they've been doing and concentrating on their 3 Rs, which is residential, retirement and retail.
But Matthew Quinn says the one big threat to Stockland's recovery and that of the wider economy is the prospect of banks raising variable mortgage rates independently of any official move on the cash rate by the Reserve Bank.
If it's a big threat to us, it is a threat to the market in general, because a threat to us is a threat to the shoppers in our retail centres, and it's also a threat to the buyers in our residential communities.
He says despite signs of improving consumer sentiment, confidence is still fragile, and even those with disposable income are not spending it. One thing he can bank on is the increasing number of retirees in Australia, and Stockland has made it clear it wants to expand its retirement living business. Its takeover offer of $1.50 a share for retirement village operator Avon was officially rejected yesterday, with the Target's board telling shareholders the bid was highly opportunistic and significantly undervalued the company. Matthew Quinn says Stockland's requests to negotiate with Avon have been refused, but maintains the offer is attractive.
We're in those early days now where there's a bit of unfortunate posturing going on about how to value retirement living and how to value businesses. Ultimately, the shareholders have to decide that. Winston
Samet says there is a case for Stockland to increase the bid by around 10 cents a share.
For a company that's got a market cap of $9 billion, it's really neither here nor there. If they really want to take Avon, they may have to pay a little bit more, but I don't see them paying $2.
Matthew Quinn says he has no plans to turn the bid into a hostile takeover, and added he doesn't feel any pressure to pursue acquisitions of fellow property companies, GPT and FKP, in which Stockland has held strategic stakes for some time.